11 of these 12 rules are obvious. You've heard them before. Risk 1% per trade. Use stop losses. Don't overtrade. But rule number 12, the one nobody talks about, is the one that determines whether the other 11 actually work. Because you can follow every risk management rule perfectly and still destroy yourself if you violate this 12th principle. And most traders violate it every single day without realizing it. They think they're being disciplined when they're actually being reckless in a way that's invisible until it's too late. I'm going to show you what that 12th rule is and why it's the difference between traders who survive and traders who don't. But before I get there, I need you to understand something fundamental about what risk management actually is. Because most traders have it completely wrong. They think risk management is about protecting their money, about not losing too much on any single trade, about preserving capital. And that's not wrong exactly, but it's incomplete. It's focusing on the wrong variable. Risk management isn't primarily about protecting your money. It's about protecting your ability to think clearly. Because the moment you risk too much, the moment a trade becomes too meaningful to you emotionally, your nervous system takes over and your rational brain shuts down. You stop being a trader executing an edge and you become a frightened animal trying to avoid pain or a desperate gambler trying to make back losses. You can have the perfect strategy, the best entry system in the world, flawless technical analysis, and you will destroy yourself with improper risk management, not because you lost money, not because your strategy failed, but because you lost your mind. You lost your ability to execute your process. You lost your psychological clarity. And without that clarity, without that ability to think objectively, your strategy becomes irrelevant. Your edge disappears. All your knowledge and skill become useless because you can't access them through the fog of fear or greed or desperation that improper risk creates. You think you have risk management figured out. I know you do. You've read the books. You've taken the courses. You know to use stop losses. You know not to risk more than 1 or 2% per trade. You've got your position sizing calculator programmed into your spreadsheet. You understand risk-reward ratios. You've got all the textbook knowledge, but you're still losing. Or you're barely breaking even. Or you had a beautiful run of winners and then one bad week wiped out months of gains and you can't figure out why. Because you're following the rules. You're doing what you're supposed to do. So what's going wrong? What's going wrong is that the rules you're following are incomplete. They address mathematical risk, but they completely ignore psychological risk. And psychological risk is what kills trading careers, not mathematical risk. You can survive losing 2% per trade mathematically. Your account can handle that drawdown. The numbers work. But can your psychology handle it? Can your confidence survive it? Can you take the 15th losing trade in a row with the same emotional state you took the first? Because if you can't, then the mathematical risk is irrelevant. You're going to stop executing your edge. You're going to start deviating from your plan. You're going to make emotional decisions. And that's when the real damage happens. You're managing risk on paper, but not in reality. Your rules say risk 2%, but you feel like you're risking everything. Your rules say take the next trade, but you can't because the last loss shook you to your core. Your rules say stay disciplined, but you keep making exceptions because the fear or greed or need to make it back is overwhelming and you can't resist it. There's a gap between your risk management plan and your actual psychological capacity for risk, and that gap is where you're bleeding. You're bleeding confidence. You're bleeding consistency. You're bleeding your will to continue. You're bleeding your trading life. Traditional risk management treats all losses as equal. You lose 2%, you take the next trade. You lose 2% again, you take the next trade. Just keep following the math. The math says you can survive 100 consecutive losses at 2% per trade. So just keep taking trades. But psychologically, losses aren't equal. They're not the same. The 10th losing trade in a row does more psychological damage than the first, way more. The loss that confirms your worst fear about yourself, that maybe you're not good enough, that maybe you can't do this. That loss hits completely different than the loss that was just bad luck. The loss you take after violating your own plan destroys you in ways that following your plan never would. Real risk management accounts for this psychological inequality. It protects not just your capital, but your ability to continue executing your edge. Risk management isn't defensive. That's what most traders think. They see it as limiting their gains, as being overcautious, as preventing them from maximizing opportunities, as the thing that keeps them from getting rich quick. But that's completely backwards. Proper risk management is what allows you to be aggressive when you should be. It's what allows you to take every signal your edge generates, without hesitation, without fear, without second guessing. It's what keeps you in the game long enough for your edge to actually work. Because edges don't work on 10 trades, they work on thousands of trades. And you can't get to thousands if you blow up on trade 50 because your risk management was only mathematical instead of psychological. The traders making the most money aren't the ones taking the biggest risks per trade. They're not the ones going all in on high conviction setups. They're the ones managing risk so well that they can afford to be consistently aggressive, to take every opportunity, to execute flawlessly over years and decades without ever facing the psychological damage that makes execution impossible. I'm going to give you 12 rules, not complicated mathematical formulas, not position sizing calculators that require a PhD to understand. Simple, clear, psychologically grounded principles that address both the numbers and the emotions, both the account balance and the mental state. And if you follow these 12 rules, really follow them, not just intellectually agree with them, but actually implement them as law in your trading, you'll protect not just your account, but your sanity, your confidence, and your trading longevity. Let me tell you about a trader I knew. We'll call him David. David did everything right on paper. And I mean everything. Perfect risk management according to every textbook ever written. He risked exactly 1% per trade. Never more, never less. Used stop losses on every single position. Had his position sizing calculator programmed into his spreadsheet, and he used it religiously. Never deviated. His risk management was textbook perfect, and he blew up anyway. Not slowly, over years, catastrophically over weeks. And when I looked at what happened, when I went through his trading journal and his account statements, the numbers didn't make sense. How do you blow up risking 1% per trade? The math doesn't work. You should be able to survive forever at 1%. Here's what actually happened. David had 12 consecutive losing trades, 12 in a row. Now, mathematically, that's a 12% drawdown, completely survivable. His account should have been absolutely fine. He had plenty of capital left, plenty of room to keep trading, but psychologically, those 12 losses destroyed him, absolutely destroyed him. Because around loss number 7, he started doubting his strategy. Is this edge even real? Does this system actually work? Around loss number 9, he started doubting himself. Maybe I'm not cut out for trading. Maybe I don't have what it takes. By loss number 12, he was in complete despair. He was questioning everything, his strategy, his abilities, his decision to become a trader, everything. And then trade 13 came up. A perfect setup. Exactly what his edge looked for. All his criteria met. His rules said take it. But he couldn't. He was too scared. Too traumatized by the 12 losses. What if this one loses too? What if it's 13 in a row? I can't take another loss. I can't handle it. So he skipped it. And that trade won. Would have been a big winner. Would have started a winning streak that would have brought him back to break even and then to profit. But he missed it. And he missed the next one too because he was still scared. And the next, and by the time he finally did take another trade, he wasn't executing his edge anymore. He wasn't following his process. He was trying to make back what he'd lost emotionally, even though he hadn't lost that much financially. He was revenge trading, oversized positions, taking trades that didn't meet his criteria because he needed to win, needed to prove to himself he could still do this. All the discipline was gone. All the careful risk management was abandoned. And that's when the real damage happened. That's when the 12% drawdown became 50%. Then 70, then he was done. account blown, confidence shattered. And it all started because he thought risk management was just about the math. He didn't understand that his psychology had limits that the spreadsheet couldn't measure. That 12 consecutive losses at 1% might be mathematically survivable, but psychologically catastrophic. How many losses can you take before you can't take the next trade cleanly? Not theoretically. Actually. In reality. With your actual psychology. Not the psychology you wish you had or think you should have, the psychology you actually have right now. That number, that's your real risk limit. Not what the math says, what your psychology says. Let me give you another way to think about this. Imagine you're crossing a rope bridge over a canyon, a deep canyon, one of those suspension bridges made of rope and wooden planks. And you're standing at one end looking across to the other side, and an engineer comes up to you and shows you calculations, shows you that the bridge is solid, that it's been certified, that it can hold 10 times your weight, that statistically, mathematically, you're completely safe. The numbers are irrefutable. The bridge is strong. You will not fall. But you step onto the bridge and it sways. It moves under your feet. The wind catches it and it swings side to side. The wood planks creak. You can see through the gaps between the planks to the drop below, hundreds of feet down to rocks and river. And your hands are shaking. Your heart is racing. Your breathing is shallow. You're gripping the rope rails so tight your knuckles are white. You can barely move forward. You're frozen, terrified. Are you safe? Technically, yes. The engineer's calculations are correct. The bridge will hold you. But psychologically, no. You're not safe at all. Because if you're too terrified to walk, if the fear has paralyzed you, then the bridge's strength doesn't matter. You're stuck. You can't get to the other side. The math says you're fine, but your experience says you're in danger. That's trading with pure mathematical risk management. Your spreadsheet says you're safe. The numbers say you can survive 100 consecutive losses at your current risk level. But if your psychology can't handle 10 losses, if loss number 10 makes you freeze, makes you unable to take trade 11, then the math is completely irrelevant. You need to manage risk at a level where you can keep walking across the bridge without your hands shaking, where you can look down through the gaps and not freeze, where you can move forward with confidence even when the bridge sways in the wind. That's the difference between theoretical safety and actual survival. What if proper risk management means risking less than the math says you can handle? What if the right amount of risk has nothing to do with percentages and everything to do with your emotional capacity? What if you need to risk half of what you think you should risk just so you can actually execute your process? Here's rule number 1. Never risk more than you can lose and sleep. Forget percentages for a minute. Just forget them. Before every trade, I want you to do this. Close your eyes and visualize the trade hitting your stop loss tonight while you're sleeping. Really imagine it. You go to bed with this position on. You wake up in the morning and the trade hit your stop. You lost. How do you feel? Not financially. How do you feel emotionally? Will you be okay tomorrow? Will you wake up traumatized? Will you spend the next day obsessing over it, replaying it, questioning yourself, feeling sick? If yes, you're risking too much. It doesn't matter what percentage it is. If it's going to create that kind of emotional damage, it's too much. The right amount of risk is the amount that lets you close your trading platform and go live your life without constant anxiety, without checking your phone every 5 minutes, without that knot in your stomach, without lying awake at night doing mental math about worst-case scenarios. If you can't sleep, you're risking too much, period. No discussion. Doesn't matter what the textbooks say. Doesn't matter what other traders are doing. For you, for your psychology, for your nervous system, that size is too big. Rule number 2, your stop loss is your lifeline, not a suggestion. I've watched traders, hundreds of them, treat stop losses like they're negotiable, like they're suggestions, like they're just general guidelines that can be adjusted based on how they feel in the moment. They set a stop loss, price approaches it, and they think, wait, maybe I should give it more room. Maybe I set my stop too tight. Maybe it just needs a little more space to work, so they move it, just a little bit. just to give the trade a chance. And then price keeps going against them and they move it again and again, and what was supposed to be a 1% loss becomes 3%, then 5%, then catastrophic. That's not risk management. That's self-destruction. Your stop loss is sacred. It's the price where your analysis is invalidated, where the market is telling you you're wrong, where you accept being wrong and exit with dignity. Moving it isn't being flexible. It's not being sophisticated. It's being dishonest with yourself about what you can actually afford to lose. It's letting hope override your plan. And hope is expensive in trading, more expensive than anything else. Rule number 3, risk less during drawdowns, not more. This one violates every instinct you have. When you're losing, when you're in a drawdown, every fiber of your being tells you to risk more, to be aggressive, to take bigger positions because you need to recover faster, to make it back, to prove you can bounce back, to show the market you're not scared. But that's exactly when you should risk the least, the absolute least. Because drawdowns affect your judgment. You're no longer objective. You're no longer neutral. You're emotional. You're either scared or desperate or angry or some combination of all three. And emotional trading with bigger size, that's not courage. That's not being aggressive. That's suicide. When you're in a drawdown, cut your size in half. I don't care what your rules normally say. Cut it in half. Give yourself room to breathe, room to get your head straight, room to prove you can execute your process again without the pressure of needing to make back what you lost. Because if you can execute perfectly with half size during a drawdown, you'll recover. It'll just take longer. But if you increase size and keep executing poorly, you won't recover. You'll blow up. And then there's nothing to recover to. But even if you follow these 3 foundation rules, even if you never risk more than you can sleep with, even if you honor your stops religiously, even if you cut your size during drawdowns, there's a psychological trap most traders fall into that destroys them anyway. Rule number 4, never risk more than you're willing to be wrong about. This sounds similar to rule 1, but it's different. It's about something else entirely. Some trades you're more confident about than others. You've done extra analysis. Everything lines up. Multiple time frames confirming, volume confirming, everything. And you feel certain this is going to work. I know this is going to work. And that confidence, that certainty, it affects how much you can psychologically handle losing. Because if you're somewhat uncertain about a trade, if you're taking it just because it meets your criteria but you're not super confident, losing that trade shouldn't sting much. You were uncertain anyway. Of course it might not work. But if you're very confident, if you're certain, if you know it's going to work, and then you lose, that hits completely different. That hits your ego. That hits your sense of your own competence. That makes you question everything. So paradoxically, the trades you're most confident about should have smaller position size, not larger. Because the psychological cost of being wrong when you were certain is higher than the psychological cost of being wrong when you were uncertain. Most traders do the opposite. They size up on high conviction trades. And then when those trades lose, which they will because nothing is certain, the psychological damage is massive. Rule number 5. Your position size should make you slightly uncomfortable, not terrified. This is about finding the sweet spot. Too small and you're not engaged. You don't care. It doesn't feel real. You won't follow through properly because there's no skin in the game. But too large, and you're paralyzed. You can't think. You can't execute. You're watching every tick like your life depends on it. The right size is in between, slightly uncomfortable. Where you care about the outcome but you're not traumatized by it. Where you're invested but not desperate. Where you feel it but you're not overwhelmed by it. Find that size and stay there. Don't immediately try to scale up. Stay there until it becomes comfortable. Until that size that made you slightly uncomfortable now feels normal. Then increase it slightly, by maybe 25%. And stay at the new size until that becomes comfortable. This is slow. It's unglamorous. Your ego will hate it. but it's how you build psychological capacity for larger size without destroying yourself in the process. Rule number 6. Scale your position size with your psychological state, not just your account size. This is huge and almost nobody does this. Your position size in most risk management systems is based on your account size. You risk a percentage of your account. Account goes up, risk goes up proportionally. Account goes down, risk goes down. That's fine mathematically, but psychologically it's incomplete because your psychological capacity for risk isn't static, it fluctuates. You have good weeks where you feel confident, where you're executing flawlessly, where everything is clicking. And you have bad weeks where you're shaky, where you're doubting yourself, where you're making mistakes. When you're in a good state, when your confidence is high, when you're executing perfectly, you can handle slightly larger size. Not to celebrate, not to make more money, but because your psychological capacity has temporarily expanded, you can carry more weight. But when you're in a bad state, when you've lost confidence, when you're not executing well, you need to trade smaller, much smaller. Not because your account is smaller, because your psychology is compromised, because you can't handle the same emotional load. Your position size should flex with your mental state. If you rate your confidence and clarity on a scale of 1 to 10 and you're below a 7, cut your size in half. Above an 8, you can increase by 25%, but always tied to your psychological state, not just your capital. These 6 rules protect you from catastrophic losses. They create the foundation for survival. But there's another category of risk that nobody talks about. Hidden risks that destroy traders without them even realizing what's happening. Rule number 7. Protect yourself from opportunity cost trauma. Missing a big winner, seeing a trade you recognized but didn't take, go on to make huge gains that can damage you as much as a loss, sometimes more, because it confirms your deepest fear that you're not good enough, not fast enough, not brave enough, that you don't have what it takes, that you're always going to be on the outside looking in while other traders make money, and that psychological damage, that trauma of missing out, it makes you do stupid things on the next opportunity. It makes you jump in without proper analysis because you can't miss another one. It makes you abandon your process because following your process made you miss the last one. So you need rules for when you don't take trades too. You need to document why you skipped a trade. Write it down. Was it because the trade violated your edge? Because it didn't meet your criteria? Then you made the right decision. You were disciplined. You followed your process. The fact that it won anyway is just variance. That's the market being random. But if you skipped it because of fear, because you were scared, because you didn't trust yourself, that's different. That's something to work on. That's a psychological issue. But either way, creating a record of why you didn't take the trade prevents the missed opportunity from becoming psychological trauma. Because you have an explanation, a reason. It's not just, I failed or I wasn't good enough. It's, I followed my rules or I need to work on my fear. Both of those are actionable. Both of those prevent the spiral. Rule number 8. Protect yourself from winning incorrectly. This sounds weird, but it's critical. Winning while breaking your rules is more dangerous than losing while following them. Way more dangerous. Because when you win while breaking your rules, you're teaching your brain something catastrophic. You're teaching it that discipline doesn't matter, that you can feel your way through this, that your rules are optional, that exceptions work. And then next time you feel like breaking your rules, you'll do it, because you did it before and it worked. But this time you'll lose, and then you won't know what to trust. Your rules or your instincts, your plan or your feelings. Winning incorrectly creates confusion that's harder to recover from than any loss. Because at least with a loss while following your rules, you know your process works over time. This trade just didn't work. But with a win while breaking your rules, you don't know anything. You don't know if you should be disciplined or flexible, if you should follow your plan or trust your gut. And that confusion will paralyze you. Rule number 9. Never put all your psychological capital in one basket. This isn't about correlation between positions. It's not about portfolio diversification in the traditional sense. It's about emotional diversification. Don't take trades where the outcome matters too much to you, where you need it to work for reasons beyond the trade itself, where you're trying to prove something to yourself or someone else, where you're trying to make up for a previous loss, where you're trying to save your month or your week or your confidence. Because when you need a trade to work, when you're emotionally all in, when everything is riding on this one trade, you lose objectivity. And without objectivity, your edge disappears. You stop seeing what is and start seeing what you need to see. Every trade should be just another trade, another execution of your process. Not the trade that saves you or proves you or defines you, just another trade in a series of thousands. The moment a single trade becomes too important, you're in danger. Reduce the size until it's not important anymore, until it's just another trade. And now we come to the final 3 rules. The meta layer, the rules about the rules, the principles that tie everything together and determine whether the other 9 actually work. Rule number 10. Your risk management rules must be simpler than your strategy. If your risk management requires calculation and thought and decision-making in the moment, you won't follow it under pressure. You can't. Because in the moment, when you're in a trade, when money is on the line, when you're stressed, you don't have spare cognitive capacity for complex calculations. You're using all your brain power just to manage your emotions and watch the trade. So your risk management needs to be so simple you can execute it when you're emotional. So simple a child could follow it. Risk 1% per trade. Stop goes here. Target goes here. Period. No complexity. No if this then that. No multiple scenarios. Just simple, clear, executable rules that work even when your IQ drops 40 points because you're scared or excited. Rule number 11. Review your risk management rules weekly, not during trades. You're not allowed to adjust your risk management in the moment. That's when emotion is highest and judgment is worst. Your risk management rules are decided during your weekly review. Sunday night, when you're calm and objective and not in any trades, you look at your results. You assess your psychological state. You decide what your risk limits are for the coming week. And once decided, they're law. They're non-negotiable. No adjustments, no exceptions, no special cases. You execute what calm you decided, not what emotional you wants. Because emotional you is trying to survive. Calm you is trying to build a career. And calm you is smarter. And now, rule number 12. The one I told you about at the beginning. The one that determines whether all the others work. Protect your psychological capital above all else. Your psychological capital. Your confidence. Your ability to execute. Your emotional stability. Your clarity of thought. That's more valuable than your financial capital. More valuable than your trading account. Because you can always make back money. If you blow up your account but your psychology is intact, you can start over. You can rebuild. But if you lose your ability to trade without fear, without hesitation, without doubt, if you lose your confidence, if you lose your emotional stability, you can't make back anything. You can't trade. You're done. Not because you don't have capital, because you don't have psychology. So every decision you make, every trade you take, every risk you accept, you have to ask yourself one question. Does this protect or deplete my psychological capital? Does this build my confidence or damage it? Does this support my emotional stability or undermine it? If it depletes, if it damages, if it undermines, don't do it. I don't care how good the trade looks. I don't care what the potential profit is. If it's going to cost you psychological capital, it's too expensive. Because psychological capital is the only thing you can't replace. So how do you actually implement these 12 rules starting today? Let me make this practical. Let me give you a framework you can use immediately. First, create your personal risk limits. Sit down with a piece of paper and answer this question. What's the maximum I can lose in one trade and still take the next trade with a clear mind. Not what the math says you can lose. Not what other traders lose. Not what the textbooks recommend. What can you actually, psychologically, emotionally handle losing and still function? Be honest. Brutally honest. That number might be 0.5%. It might be 0.2%. It might be 0.1%. Whatever it is, honor it. Write it down. That's your personal risk limit. And yes, it might feel embarrassingly small. Your ego might be screaming that real traders risk more. Ignore that. Real traders risk what they can handle. Fake traders risk what their ego demands. And fake traders blow up. Second, do the sleep test before every trade. Before you enter any position, close your eyes. Visualize it hitting your stop tonight while you're sleeping. Really feel it. Really imagine waking up to that loss. How do you feel? Sick? Anxious? Angry? Then you're risking too much. Adjust your size. Make it smaller. Keep adjusting until you can visualize the loss and feel only mild disappointment. Just, okay, that one didn't work. Let's take the next one. That's the right size. That's the amount you can actually handle. Third, calculate your consecutive loss threshold. How many consecutive losses at your current risk level would make you unable to take the next trade? Be honest. If it's fewer than 20, you're risking too much. You need enough cushion to survive a statistically normal losing streak without psychological damage. Losing streaks of 10, 15, even 20 trades are completely normal. They happen to everyone. So you need to be able to survive 20 or 25 consecutive losses and still be able to take trade 26 with the same emotional state you took trade 1. If you can't, reduce your risk per trade until you can. Fourth, do a weekly risk review. Every Sunday, sit down and review your risk management. How many rules did you follow perfectly this week? Which rules did you violate? Don't do this for judgment. Don't beat yourself up. Do it for awareness. Track your compliance percentage. Rule 1, followed or violated. Rule 2, followed or violated. Go through all 12. Your goal is 100% compliance with your own rules. Not 100% win rate, not maximum profit, 100% compliance. Because compliance is what you control, outcomes you don't. Fifth, keep a psychological capital journal. After every trade, win or lose, rate your psychological capital on a scale of 1 to 10. How confident do you feel right now? How stable? How clear? How ready for the next trade? If you drop below a 7, reduce your position size by half, immediately. Don't wait. Don't try to push through. You're running low on psychological capital and you need to protect what you have left. If you're consistently above an 8, if you're executing flawlessly and feeling great, you can increase your size by 25%, but only if you're above an 8. Your size should be a direct reflection of your psychological state. Let me bring this all together for you. You came here thinking risk management was about percentages and stop losses, about protecting your money, about position sizing calculators. And what I've shown you is that money is the least important thing you're managing. You're managing your psychology, your ability to think clearly, your capacity to continue executing your edge, regardless of what happened on the last trade or the last 10 trades. The 12 rules aren't about being conservative. They're not about limiting your success. They're about staying in the game long enough to win, about creating the conditions where you can survive the inevitable variance that destroys everyone who isn't properly protected. Foundation. Never risk more than you can lose in sleep. Your stop loss is your lifeline, not a suggestion. Risk less during drawdowns, not more. Execution layer. Never risk more than you're willing to be wrong about. Your position size should make you slightly uncomfortable but not terrified. Scale your size with your psychological state, not just your account size. Hidden risks. Protect yourself from opportunity cost trauma. Protect yourself from winning incorrectly. Never put all your psychological capital in one basket. Meta layer. Keep your rules simpler than your strategy. Review your risk management weekly, not during trades. and protect your psychological capital above all else. Risk management isn't defensive. It's not about playing it safe or being scared or limiting your potential. It's offensive. It's strategic. It's about creating the conditions where you can be consistently aggressive, where you can take every trade your edge generates without hesitation, where you can survive the inevitable losing streaks that break everyone else. The traders making the most money, the real money, the career money, they're not the ones taking the biggest risks per trade. They're the ones managing risk so well that they can afford to take every opportunity their edge presents. They can afford to be in the game for decades. They can afford to compound. Because they never risk their psychological capital. They never put themselves in a position where one trade or 1 week or 1 month can damage their ability to continue. You have permission right now to risk less than you think you should. You have permission to trade smaller than other traders. You have permission to prioritize protecting your psychology over maximizing your gains. Because the traders who prioritize psychology over profit in the short term are the ones who end up with both in the long term. And the traders who sacrifice psychology for profit, who risk their mental stability for bigger gains, they end up with neither. They blow up. They quit. They become part of the 95% who fail. Here's what I want you to remember. I am not trying to maximize every trade. I am not trying to squeeze every dollar out of every move. I am trying to survive every losing streak. I am trying to protect my ability to continue. I am not managing my money. I am managing my mind. My risk management isn't about my account balance. It's about my psychological capital. It protects my most valuable asset, my ability to execute my edge without fear, without hesitation, without doubt. And that ability, that psychological clarity, that's what creates wealth over time. Not individual trades, not big wins. Consistency over years. And consistency requires protection. You'll be tempted to violate these rules. I need to warn you about this because it's going to happen. When you see a perfect setup, when you're absolutely certain, when you've had a few losses and you need to make it back, when everyone else seems to be making money and you're not, every single rule will be tested. You'll find reasons why this time is different, why you can make an exception, why your situation is special. And in those moments, I need you to remember something. Every blown-up account belonged to a trader who made exceptions, who thought this time was different, who believed they could handle more risk than their rules allowed. The rules exist to protect you from your own optimism, your own fear, your own humanity. Follow them even when you don't want to, especially when you don't want to, because that's when you need them most. If these 12 rules challenge something you thought you knew, if they showed you that you've been managing risk incompletely, if you're willing to protect your psychology as fiercely as you protect your capital, hit that like button right now. Not for me, not for the algorithm, as a commitment to yourself, as an acknowledgement that you're choosing survival over short-term gains, that you're choosing longevity over excitement, that you're choosing to become a trader who lasts instead of a trader who flames out. Drop a comment and tell me which rule you violate most. Which one is your weakest point? Is it risking more than you can sleep with? Is it moving your stops? Is it sizing up during drawdowns? Is it putting too much emotional weight on individual trades? Tell me. Because naming your weakness is the first step to protecting it. And I want to see traders become conscious of their patterns instead of being controlled by them. And subscribe for more content on the psychological infrastructure of trading, the unsexy, disciplined, survival-focused principles that actually create longevity. Because most trading content out there is about how to make money, how to find entries, how to catch big moves, and that's fine. But this is about something more important. This is about how not to lose your ability to make money, how to protect the thing that actually generates profit, which is your psychology. And that distinction is everything. You're not being conservative by following these rules. You're not being scared. You're being smart. You're being strategic. You're being someone who understands that trading is a marathon, not a sprint. And marathons are won by those who manage their energy, not by those who sprint fastest in the first mile. Now go implement these 12 rules. Make them law. in your trading. Write them down. Put them where you can see them. Review them weekly. Track your compliance. And watch what happens when you stop managing risk on paper and start managing it in reality. When you stop protecting just your money and start protecting your mind.